A 10% dividend yield is either the best deal in the market or a preview of a dividend cut. Sorting stocks by yield without any quality checks puts the most distressed names at the top of your list. Here's how to filter them out. Dividend yield is annual dividend per share divided by stock price. A stock at $50 paying $2 per year yields 4%, roughly double the S&P 500 average. If you're building an income portfolio, high-yield stocks are the obvious starting point. The problem is that yield is a ratio with two moving parts, and both can make it go up. If the company raises its dividend, yield goes up. That's good. If the stock price collapses and the dividend stays flat, yield goes up too. That's usually not. A company trading at $100 with a $3 dividend yields 3%. If the stock drops to $50 and the company hasn't cut the dividend yet, the yield jumps to 6%. The yield doubled. Nothing positive happened. This is the yield trap. You buy a stock yielding 10%, the company cuts the dividend 6 months later, and the stock falls another 30% on the cut announcement. Your income investment just destroyed capital. The highest yielders on any raw screen are often stocks in freefall where the dividend hasn't been cut yet, not bargains. Fama and French tested this across 13 international markets from 1975 to 1995. High-yield stocks were among the value metrics that consistently outperformed, beating growth by an average of 7.7% per year. The premium is real. The market overreacts to bad news, prices drop, yields rise, and patient investors who buy during that pessimism earn the recovery. Arnott, Su, and Moore confirmed the mechanism in 2005. Dividend-weighted indices beat the S&P 500 by roughly 2% annually over 4 decades, driven by contrarian rebalancing that systematically buys beaten-down yields and sells compressed ones, but, on average, covers a lot of traps. The top yield decile contains genuine bargains and companies heading for zero. The decile outperforms, but individual traps can devastate a concentrated portfolio. Piotrowski addressed the broader problem in 2000. He showed that applying fundamental health screens to value stocks improved returns by 7.5% annually. The principle applies directly here. Filter the junk, keep the bargains. 4 filters do most of the work in our screen: payout ratio, free cash flow, return on equity, and debt to equity. So let's build the screen. One SQL query that pulls every U.S. large-cap stock yielding between 4% and 15%, then applies payout ratio, free cash flow, return on equity, and debt-to-equity filters to keep only the names that can actually sustain their dividends. We join 3 tables: financial ratios for trailing 12-month yield, payout ratio, and debt-to-equity, key metrics for return on equity, and market cap, profile for exchange, sector, and the funder stock check. Walk through the where clause. The yield range from 4% to 15% sets a floor at roughly double the S&P 500 average and caps out at 15%, to exclude extreme situations where a dividend cut is almost certain. Payout ratio between 0 and 80% means the company keeps at least 20 cents of every dollar earned after paying dividends, which is your buffer against a bad year. Return on equity above 8% removes struggling businesses where the high yield reflects poor fundamentals. Debt to equity below 2.0 keeps leverage manageable so the company isn't borrowing to fund the distribution. Market cap above $1 billion keeps the screen focused on liquid, institutionally covered names. The exchange filter restricts to U.S.-listed common stocks, and the IS fund and IS EDF checks drop closed-end funds and ETFs that show up with deceptively high payout numbers driven by return of capital, not earnings. Real estate investment trusts show up frequently because they're required to distribute 90% of taxable income. Telecoms, utilities, and energy round out the typical results. Most results show yields between 4% and 8%. Anything above 10% that passes every filter deserves extra scrutiny because the quality screens don't catch every deterioration in progress. The 4 quality filters each do a different job, and that's intentional. Payout ratio creates a buffer against earnings volatility. If profits dip 20%, the dividend is still covered because the company was only paying out 80% to begin with. Above 80%, there's no cushion. Above 100%, the company is borrowing to pay dividends, and that doesn't last. Free cash flow, captured by the free cash flow filter in the full backtest, and indirectly here through the payout ratio, is the more honest version of earnings. Accounting profits can be massaged. Cash in the door minus cash out the door is harder to fake. The full backtest adds a positive free cash flow requirement on top of the payout cap. The live trailing 12-month screen relies on the payout ratio to do most of that work, because trailing 12 months free cash flow can swing on a single quarter. Return on equity above 8% removes companies that simply can't earn a decent return on the capital shareholders have provided. A 12% yield on a business that earns 3% on equity is a yield trap waiting to happen. The return on equity floor is the broad profitability check. Debt to equity below 2.0 keeps leverage in check. Highly leveraged companies pay high yields right up until they can't, and then they cut. D'Angelo, and Skinner documented that dividend cuts tend to follow prolonged earnings declines, and those deteriorations almost always show up in profitability and leverage before the cut announcement. Together, these four filters remove most of the left tail. The companies yielding 10% because they're 6 months from a cut get knocked out. What remains is the subset where the yield is high because the market was overly pessimistic, not because the fundamentals are crumbling. The screen has no sector awareness. Real estate investment trusts, utilities, and telecoms cluster near the top of yield rankings because their business models are built around distributions. The portfolio will naturally tilt toward these sectors. When they underperform as a group, the strategy underperforms regardless of how well the individual stocks are chosen. Rising interest rates hit these sectors especially hard because their valuations compete directly with bond yields. Dividend yield is backward-looking. It tells you what a company paid last year relative to today's price. It says nothing about what they'll pay next year. A company with a decade-long streak of dividend increases can still cut if the business environment changes sharply enough. The filters help, but no screen anticipates events that haven't happened yet. There's also a mechanical effect on yield itself. When you buy a position, the yield is set at your purchase price. If the stock rallies 30%, the effective yield on your cost basis looks attractive, but the current yield has compressed. If the stock falls 30%, the current yield looks alarming, even if nothing changed about the dividend. Neither move tells you whether to hold or sell. That's the quality filtered high yield screen. The query is live on CetaResearch.com. You can adjust the yield thresholds, switch exchanges, and run it against your own data. Link in the description. The full 25-year backtest is next. We'll show exactly when high-yield quality stocks dominated, when they went cold, and what 5 consecutive years of underperforming the index looks like in practice. 2011 to 2015. Subscribe so you don't miss it.